Ever wondered how big companies decide where to invest their money? Or how startups convince investors to give them millions? The secret tool behind many of these decisions is financial modeling. Let's break it down. Section 1. What is financial modeling? Financial modeling is the process of building a spreadsheet, usually in Excel, that represents the future financial performance of a company, project, or investment. It's like creating a money roadmap. With the right data and formulas, you can forecast profits, predict cash flow, and test out what-if scenarios. Section 2. Why is it important? Financial models help people make smart decisions. Want to know if a business will survive the next year? Or whether buying another company makes sense? A solid financial model can answer those questions. It's used by investment bankers, CFOs, analysts, startup founders, and even investors on Shark Tank. Section 3. What does a model include? Most financial models include these key parts: historical data, what's happened in the past; assumptions, like revenue growth, costs, or interest rates; forecasts, predicting income, expenses, and profits; financial statements, projected income statement, balance sheet, and cash flow; valuation, estimating what the company is worth. You don't need fancy software to get started. Most models are built in Excel or Google Sheets, but there are modern tools too, like Causal, Cube, and Fathom, that make modeling more visual and easier to use. It's not just for Wall Street pros, it's a powerful tool for anyone making smart money decisions. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more simple financial insights.